Welcome to the Explainer. So if you happen to check your portfolio today, July 17th, 2026, you're probably feeling a little bit of shock right now. Don't worry, you are definitely not alone. Today, we're breaking down this massive global market downturn that is pretty much everyone on edge. We're going to sift through all the noise, look directly at the data, and transform our sources into a clear, level-headed survival guide for your investments.
The real question we have to answer today is this. Are we looking at a pure panic sell-off? Like, are investors just blindly running for the hills driven by fear? Or is this actually a calculated strategic rebalancing? Just a deliberate move by the big players to shift their money to a safer table? Here's our roadmap for the Explainer. We'll start with how red is covering the globe, dig into the collapse of AI tech, identify the two choking risks, look at the new cash flow rotation, and finally ask, correction or recession? Let's jump right in.
All right, Section 1. Red covers the globe.
So Asia basically woke up to what traders are already dubbing a Black Friday. Japan's Nikkei 225 took an absolutely brutal downward spike today, tumbling all the way down to 64,141.12, slicing right through previous support levels.
Just let that number sink in for a second. 14.7%. That is how much the Nikkei has dropped from its historical peak. And the driver here? It's panic selling, pure and simple. Specifically, massive sell-offs in semiconductor and AI giants like SoftBank and Kioxia. And honestly, it's wild, because this is happening even though other industry leaders like TSMC and ASML recently posted really solid profits. Right now, fear is just completely overriding the fundamentals.
And because our global markets are so deeply intertwined, that contagion spread to Europe almost instantly. As soon as European markets opened, they were bathed in red. The STOXX 50 dropped nearly 0.7% right out of the gate, plunging down to around 6,206 points. Just like in Asia, tech stocks are acting like a massive anchor here, dragging down any attempt by the traditional sectors to mount a recovery.
Moving on to Section 2, the collapse of AI tech. Now, looking at the US, massive profit-taking is weighing incredibly heavily on the markets. The S&P 500 slipped down to around 7,533 points, which is a drop of about 0.5%. That's a pretty significant hit for the broader market, but honestly, the S&P is only giving us half the story. The real carnage, that's happening in the Nasdaq 100, which is basically the ultimate proxy for big tech. Futures are just continuously breaking short-term bottoms, plunging over 2%. We are literally watching money flee AI stocks at breakneck speed. So why is this happening today? That brings us to Section 3, two choking risks. To understand the first big risk, we need to quickly talk about CAPEX, or capital expenditure. In our current market context, CAPEX is the money a company spends to buy, build, or upgrade fixed assets. And over the past year, the tech industry has been spending absolute trillions. We're talking numbers that rival the GDP of entire countries on AI servers, data centers, and advanced infrastructure. And that leads us straight into the AI valuation bubble. See, during the first half of 2026, investors blindly trusted the promise of AI growth. The market was running unbelievably hot. But here we are, right in the middle of Q2 earnings season, and the market is getting a really harsh reality check. Investors are looking at those trillions spent in CapEx and asking one very important question. Where are the profits? They're realizing these massive investments just aren't yielding proportionate returns yet. And that realization is triggering a massive portfolio rebalancing, where investors are dumping expensive tech stocks to hoard cash.
So we're dealing with a pretty nasty dual threat environment right now. On one side, we have this internal market risk, the AI bubble leaking and sparking a major sell-off. But colliding with that, we have a severe external geopolitical risk, escalating tensions in the Middle East that are threatening to trigger global energy inflation. Looking objectively at the economics here, recent escalations between the US and Iran in the Strait of Hormuz have caused crude oil prices to just absolutely spike. This is a huge problem because just earlier this week, we had great CPI data showing that inflation was finally cooling down. A sudden surge in energy costs threatens to completely wipe out all of that recent progress. And that geopolitical reality breeds a very specific fear in the market. Because higher energy costs threaten to revive inflation, the market is suddenly terrified that the US Federal Reserve is going to delay cutting interest rates. The whole hope for cheaper borrowing costs is evaporating, and that fear is aggressively biting the market right now.
But the money isn't just vanishing. That takes us to Section 4, new cash flow rotation.
First, a quick warning for the short term. Analysts are forecasting about 1 to 2 weeks of high market turbulence ahead. The selling pressure on tech might not be over just yet. The market is essentially going to hold its breath and shake until giants like Apple, Microsoft, and Nvidia finally release their earnings reports to either prove their financial strength or, well, confirm the market's worst fears. But while all that turbulence plays out, where exactly is the smart money flowing? Institutional investors aren't trying to catch a falling knife in the tech sector, that's for sure. Instead, the capital bleeding out of AI is actively rotating. We're seeing huge chunks of money move into historically undervalued sectors like small caps, banks, and real estate.
Why those specific sectors? Well, because they're positioned perfectly for the eventual pivot. Right now, small caps, banks, and real estate have very cheap, highly attractive valuations compared to tech. Plus, these are the exact sectors poised to be the absolute biggest winners when the Fed does, eventually, cut interest rates later this year. The big players are just setting up their chess pieces for the next phase of the economic cycle.
Which brings us to the big finale, Section 5, correction or recession.
We really need to clearly distinguish between a market correction and a full-blown global recession. A correction is just a standard 2 to 4% pressure release after a market has run a bit too hot for too long. A recession, on the other hand, is a fundamental, structural collapse of the global economy.
The sources we're analyzing today are very clear on this point, and frankly, it's a massive relief. The market is currently undergoing a trial by fire. What we're experiencing today is a necessary release of the massive, unsustainable pressure that built up during the blind optimism of the AI boom. Look, I know it hurts to look at your portfolio today, but this is actually a healthy, completely necessary mechanism at work, not the onset of a global economic recession.
Which leaves us with one final thought to consider. You now know the root causes of today's drop. And more importantly, you know that the big investors are simply moving their chips to a different table. So, knowing all this, how are you going to adjust your own strategy to capture this new flow of money? Are you going to just ride out the turbulence, or is it time to look at those undervalued sectors yourself? Thank you so much for joining us for this explainer. Keep a really close eye on those upcoming earnings reports, and stay focused out there.